Okay, welcome to this new lesson. In this part of this lessons, we're actually going to get started with the market structure. So basically, I want you to know that we have three main markets. So the market is either trending up or down, or is in a ranging market where it is two horizontal lines where it is playing in between. So we call those support and resistance, as we have explained earlier. So it will play in those between those two lines until it actually breaks through to either the upside or the downside. So that's what we call by ranging markets. And then we have the choppy market. So during the choppy markets, we don't really try to trade those because there's really no either a trend or a ranging section where we can try to capture those trades. So basically, why do you exactly need to know the market structure? Well, it is one of the most important skills that every trader actually needs, because this ability to read the market structure is a critical skill that will allow you to be able to use the right price action strategies that you're going to learn in this course in the right market condition. Otherwise, if you're going to use the strategies for a ranging market in a trending market, you're basically going to blow your account, because there is some limits in a ranging market compared to a trending market. So this is why exactly we're going to be breaking down these market structures and why exactly how to be able to spot them and how to trade them. So you need to study how the markets moves and how traders behave in the market. So the market structure is the study of the market behavior. If you can master this skill, when you open your chart, you'll be able to see what the crowd is doing, who is in control of the market, buyers or sellers, what is the right time to enter and exit the market, when to stay away. So remember what I said about choppy markets, that is the time to stay away. Through price action analysis, you experience three types of market conditions, and you'll be able to learn how to trade them. So we have the trending markets, the ranging markets, and the choppy markets. Trending markets is what we're going to take a look at first. So this is when we're having the uptrend and the downtrend. So we're going to be taking a look at what trend are we currently in, and then be able to see how we can take some of those opportunities that will be occurring in that market. So firstly, the trending markets are simply characterized by a repainting pattern, or higher highs and higher lows in an uptrend, and lower highs and lower lows in a downtrend. In an uptrend, we have the higher highs and higher lows. So let's say the market actually starts from somewhere here, right? And then it's going up, goes up, and pulls up again. So basically what is happening here, what do we mean by higher highs? So let's say the market started off right here, right? It was coming down from somewhere there. As soon as it turned around, it starts making higher highs and higher lows. So what we mean by that is that this is a higher high, and then this is a higher low. So as you can see, what we mean here, basically the market is moving higher. As it moves higher, it makes new higher highs, it makes higher points, and then when it do its retracements, it's also making some new higher lows. What this exactly means is that when we started off here, this point was lower than this point, right? So it moved and made its new high. So this is a new high, but then at the same time, when it retraces, so that it can breathe, because remember the market moves up and down for it to continue moving, right? So it's in a trending market right now. We are on an uptrend. So this is an uptrend, and the market is going up, right? So every time that it comes back to make a breathe, right? So we call it retracement. So every time that it retraces, it actually makes a point that is higher than the previous low. So the time that it breaks higher than the previous high, this point right here, that means that the uptrend is still continuing. So as you can see, this point is higher than the previous high, and then when it retraced, it actually made a higher low. Is a low because it's retracing, right? It's a point that is lower than the previous high where when the market was at the moment, right? Because it's retracing, but then at the same time, this point is higher than the previous low. So that's why we call them higher lows and higher highs. So every time it will make, when it's pushing to the upside, it's pushing above, it's making a new high point. So it's reaching a price that is higher than what the previous market structure had been able to reach. And then when it reaches lower, it won't go beyond the previous low. That shows that it's an uptrend, because the moment that it actually breaks or comes down to the exact point where the higher low is, then we need to start looking for a breakout of that trend, or a new trend that is coming in, or maybe a ranging market. So that's exactly what you're seeing here on the 4-hour chart of USD JPY. So as you can see, we have our higher highs, higher low, and then the next point is going to be higher, than the previous point, so in both directions, so in the higher highs and the higher lows. So the retracement, as I said, is a higher low, and then the impulsive move, which what we call impulsive, but we're going to deep dive into that a little bit later in the lesson. But basically that is what is happening. So this is the actual move for the trend, but then we have a retracement, right? And then the actual move, which is going to be higher than the previous one, and then we have a retracement. So that's basically how the uptrend continues to make its moves and basically build up the uptrend, right? So I hope you understand what I'm trying to demonstrate there, but it's pretty much very simple. Higher highs, higher lows, that is how you see the market. So you just have to zoom out your chart, something like this, and then be able to see the structure for you to easily see what the market is doing and be able to interpret the trending market, right, to capture that uptrend. So that is a trading market. And then if it's a downtrend, it's basically the opposite, right? Is we have the lower lows and the lower highs, the exact opposite of what we just had right now. What is happening is that market will move lower, but then it will move a lower high, meaning that is this point is lower than this high, than the previous point where it was, so we call it a lower high. And then it's gonna move a lower low, so it's gonna move a point which is lower than the previous low, and then is again the retracement. It won't pass the previous low, higher low, or lower high. So what we mean is just this point will always be lower, even though it's moving in the upside direction, which makes it a higher, but it's lower than the previous lower high. So that is what basically is happening, right? So it will continue doing that. So if I can just quickly label it for you, we have our lower low right here, lower low, because we're now in a downtrend, right? And then here we have our lower high. So our lower high, meaning that the market tried to push up, but then it did not pass the previous point right here. So it's lower, it's still going up, but it went up, the retracement is upwards, but it's lower than the previous point. And then that's basically what is just continuing to happen. As you can see, we have another lower low here, and then a lower high. So basically, once you understand the skill of being able to spot out these higher highs and higher lows, you basically don't need any indicator to decide whether the market is bullish or bearish. It's just a visual observation of a price action. So you can just, as I said, you can just zoom out to get a clearer indication of what the market is doing, and you'll be able to see this. So you just need to practice it. Practice makes perfect. Everybody, we all know that. So basically, being able to practice and see what is the market doing on every chart that you see, you'll be able to get a better understanding of this and be able to spot it out much easier. So the key thing that I want you to take out of this lesson is basically the fact that if a market is making higher highs and higher lows, it's in an uptrend. So that's the easiest way to figure out if it's an uptrend or not. And then if it's making lower highs and lower lows, that shows that the market is bearish and the trend is going down, right? But most importantly, you need to use bigger time frames such as the H4, so the 4 hour, the daily or the weekly time frame to determine the market structure. So never try to use smaller time frames to determine the market structure, because this won't show you the real market structure. It might be just a temporary trend on that smaller time frame. So if you're looking at the 1 minute, it won't give you the true direction of the market that you will be able to get on the hourly or at least the daily, right? Trends are estimated to occur 30% of the time, so you've got to know how to take advantage of it while it is in motion. So every time that you see a trend, make sure that you make the most out of it. So let's go on to our next lesson.